Hi everyone, I'm Dale Smith, aka Journo Dale, and we're here to talk about Canadian politics. All right, we're here with University of Alberta's energy economist, Andrew Leach. I was very interested in this whole Bill C-5 thing and this notion that somehow it's going to get a pipeline built. And everyone keeps saying, is it going to improve a pipeline? But there are no pipelines and no proponents. And Danielle Smith keeps saying, I'm going to get a proponent. But there was a CP story out a week or so ago where they polled all these proponents and they said, yeah, no, we're good. So I thought Andrew might have some thoughts and insight as to what we might be looking at here.
Yeah, I mean, it's completely a cart and horse problem, right? If you have a system where either proponents don't think that they're going to get a pipeline approved or that the process is long enough that it just creates enough uncertainty about the demand, your ability to lock in shipper contracts, et cetera, you're not going to have any proponents, right? It's the same way as if I posted that my course, my elective course had an essay due every single week, I probably wouldn't have any students. That wouldn't necessarily mean there aren't students interested in energy or utilities or environment stuff, right? It's just the current circumstances would be such that they're not going to sign up. So I think what C-5 does is that at least it does open a window, particularly when you think about its interaction with C-48, where, okay, now there's actually at least the possibility that a pipeline could get built and that the oil it ships could move out of the port, right? So,
and just for everyone's edification, C-48
is the oil tanker ban.
Okay, and that's on the northwest BC coast.
Yeah.
Just to be specific here.
Yeah. So if you think about, if the tanker ban's in place, it says you can't move oil or bitumen out of Prince Rupert or Kitimat or further north, then nobody's going to build a pipeline to Prince Rupert or Kitimat or the proposed First Nations port a little bit further north. Because you can't do anything with the oil once it gets there. And I think the Prime Minister said something to that effect today or yesterday, where, of course, you have to put all the pieces together to get a proponent. So, I think it's possible. It's also possible, or at least conceivable, that the Alberta government might step up with the Alberta Petroleum Marketing Corporation and say, you know what, we're going to underwrite this. I'd be surprised if they try to do that, but it's, stranger things have happened in Alberta with energy contracts, or you might see Alberta kind of come out much more strongly and say, look, we're willing to lock in 200,000 or 250,000 barrels a day of firm shipping capacity on a pipeline, and that's going to get the attention of potential pipeline proponents in a big hurry.
Okay. And I just also wanted to note that the ban is only on persistent, I think it was the term they used, oil products, and not LNG. So if the notion is that Asia is desperate for our LNG, that terminal option would be available.
Yeah, I mean, LNG is in a little bit of a different spot because you have projects that are either fully permitted or advancing in some cases on the West Coast already. So I think there's a little bit of a let's see how the market settles in now that LNG Canada is exporting some gas, now that we have some other projects in the works. I think there's maybe a bigger market question about LNG, just because LNG is the transportation infrastructure is such a large component of the value of the gas compared to oil, right? So oil, you know how much it's worth globally. The pipeline cost is material, but once you get it to the coast, then it's the transportation costs are small. Whereas LNG, you get the gas from here to the coast, that's a really small part of your problem. Then it's the liquefaction, both capital and operating costs, that are really expensive. So it's a little bit of a different question as to whether someone's going to want to make that kind of a bet on an LNG facility or new LNG facility.
Okay. I know you've spoken previously that there are fully permitted LNG projects just waiting for like the market to give the go ahead.
Yeah, so I mean the one I use a lot is the was originally Galveston LNG's project at Kitimat, so just a little bit further up the to Bish Cove from where LNG Canada is. And it was the first LNG, but it was originally permitted as an import facility, actually, sort of
Hmm.
to give your listeners a sense of how much the gas market has moved, right? That was
Yeah.
originally an import terminal. And then maybe 2 years after it was permitted as an import terminal, they went back and said, well, actually, the market's going to go the other way, and we'd like to be an export terminal. And so that facility has changed hands a number of times. BC rules have changed a little bit, so you probably do need to renew some permits on that facility.
Okay.
But it was, at any given point in time, it was buildable or quasi-buildable, but nobody was willing to pull the trigger. And you've had some Canadian players, and Encana, for example, had a piece of it. Some big global players, Chevron and Apache had a piece, or Apache and EOG, Chevron, have all had a piece of it, looked at it and said, yeah, maybe we're just going to pass on this project. And so, that's all. Like, I think people look at LNG and say, well, the world's using natural gas, and therefore this is going to be a viable investment. But that's not the LNG investment. The LNG
Right.
investment is natural gas cheap enough in Canada relative to the price in Asia to make up for the capital cost of shipping it to the coast, liquefying it, then shipping it in LNG vessels across, and then regasifying it. It's a much more sort of capital and op intensive supply chain than the oil shipping supply chain.
Yeah, and I also think that we had a conversation in the past that in order for these facilities to basically make profit, like they need to operate for like 40 years or something to that effect to make the investment worthwhile.
Yeah, I mean the same as anything. If you have a huge spread between prices, then if your facility is exposed to that spread and you get a really beneficial market, then you could pay off way sooner than that.
Right.
But most of these facilities would be built on the back of long-term sort of processing contracts, and so those would be 25 plus year contracts that then sort of backstop or lower the risk of the facility. Otherwise, like think of how risky of a bet that is. It's not even a bet on, as I said, it's not a bet on the natural gas price. It's a bet on the difference between two natural gas prices. So it's a much riskier bet than even just the pure commodity play. And so most companies that are going to be the type of company that would build and operate that facility isn't going to want to take that kind of commodity risk. So they're going to look to somebody else to say, like a producer here, to say, I'm going to sign a long-term contract with you to take my gas from Northeast BC, ship it, process it, put it on a boat, move it somewhere else, or whatever the terms of the contract would be. But
Mhm.
there'll be long-term contracts that lock in some of the returns to that facility.
Okay. All
And
right.
it's true of oil pipelines too, right? The
Yeah.
oil pipelines will go out and secure 15, 20, some shorter term contracts for firm shipping as well.
Yeah, and that I guess was kind of my next question is do we get a sense of what the market is for something like bitumen that would move, that would I guess justify a pipeline given the changing
Yeah.
market?
It's a good question. I mean, the starting point is, oil prices are still relatively weak. They're strong enough that you can make excellent money operating an existing oil sands facility. They're high enough notionally, if you could bet on them being that high for a long period of time, to make really high returns on some new oil sands facilities.
Mhm.
But the question is, are people going to be willing to make that kind of a bet? And right now, we're not seeing a lot of new project construction. There's a couple of new projects coming on. And we don't really know. I mean, the last pipeline that went to an open season, so went out looking for shipper support, I think at this scale would have been Keystone XL around the time that Donald Trump came into office the first time around.
Right.
So we're talking about 4 years, or sorry, 8 years ago at this point.
Yeah.
And we haven't really, now that one struggled for a couple of reasons. And the big one was that a lot of shippers were locked up on Energy East. So Energy East had like 1 million barrels a day, or close to 1 million barrels a day of locked in shipping commitment. And so then Keystone XL comes to the market. There was Trans Mountain lurking as well. And so, everybody had their commitments tied up in different pipelines, and Keystone XL struggled to sort of fill its firm shipping commitments. Whether that would be the case if you went to market today, I'm sure you'd have a couple 100,000 from Alberta in
Mhm.
heartbeat. And then you probably have some of the big shippers, just the value of having an option that isn't to the US is probably going to make it worthwhile to see some other shipping contracts there. So a line the size of Gateway, so 500-ish thousand barrels a day, I think you, as the Gateway proposal anyway, I think you could get there. Whether you get to what the Premier is talking about, 1 million barrels a day, like an Energy East scale project, that's another story.
Yeah.
And if you start talking about the pipeline east and west and north and south, and I don't know, are we going in the like minor directions too? Northeast, northwest? We're going everywhere.
Yeah.
There's nowhere near, there's no market for that.
Yeah. I guess I do wonder about a west-east pipeline,
Yeah.
but essentially, like not to the East Coast because obviously the Irvings don't want to pay the premium for Alberta oil. But in order to have a land route through Canada to go to Sarnia, for example, like I'm guessing that would be. I mean, on the one hand, we could justify it in terms of energy security, but on the other hand, that's a much longer distance to go around the Great Lakes than it is the current route, which cuts through the U.S.
Yeah, having driven both, well, I'm quite driven the Enbridge right of way, but pretty darn close through the Michigan Upper Peninsula and such. It is a lot shorter to drive, to move your oil, to drive whatever you want to do
Yeah,
south of the lakes. And the challenge, of course, is that infrastructure already exists. So if we were sitting today and saying, do we want to build a new pipeline sort of through the US into Sarnia or across the top of the lake into Sarnia or into Iroquois and then
yeah,
down line 9 or something? I think that's as close to a no-brainer as you get that we would, with today's politics, we'd stay in Canada. But if you propose that today, that kind of service into Sarnia, there's a limited demand between Montreal and Sarnia, there's limited oil demand. So you just
yeah,
don't have enough refinery capacity in that region to fill both pipelines. So Enbridge is going to say, whoa, what about our existing asset that has an existing permit? And
hmm,
shippers are going to be worried about, well, what if we end up with two half-filled pipelines and then we end up paying sort of twice as much for the shipping on both of them? And so I think you're right. There's an energy security value there that wasn't there. I mean, I would have scoffed at that 5 years ago.
yeah,
And in fact, I did. But and whereas people like Peter Terzakian have been talking about why we should value energy security more for decades. So they're sort of, coming good on that view now. But I don't know that people are willing to pay enough to say, let's strand an existing line and let's build a new one to those markets. My
yeah.
sense would be no.
Okay. And I guess my last question is just something that I've kind of noticed in terms of some of the themes that you've been posting on Twitter is that so much of the assumptions that a lot of the boosters have are that it's still 2014 before the oil prices crashed, and they seem to assume that the market is going to behave the same way it did pre 2014, and we are not in that space anymore. And I'm just wondering if you can, I guess, elaborate on that a little bit.
I mean, I think, if you look back at energy investment or you think of what it was like in Alberta, either 2006 to the financial crisis, but in particular for this conversation, like 2009, 10 through to 2014, right? All of the major players wanted to be in Alberta. Everybody was pitching new projects. Prices were hot, like well above $100 a barrel. And so the oil sands was incredibly attractive. And you had the Keystone XL hearings, for example, where the conclusion was basically that oil is going to get to market no matter what, right? The
Yeah.
investment was compelling enough that unless prices dropped a lot, people were going to ship it by rail or by pipe or by Volkswagen or something. But now we're in a much lower price environment where that math doesn't really work anymore. That obviously the oil isn't going to get to market no matter what, or else people wouldn't be as bent out of shape for getting a pipeline.
Right.
So the pipeline is essentially more critical, and you have a much more consolidated industry. We essentially have, I don't know, four major firms, maybe five, depending on how you count, that are in the oil sands right now. All Canadian or Canadian-ish, with the ExxonMobil Imperial exception. And so they've got a pipeline of a queue of projects, they don't really want to build and compete with their own projects for labor, for skilled trades, et cetera. They don't want to drive those costs up again like we saw. And so you do have this, maybe a different barrier in the market to construction. And like what we've seen globally is investment's down. It's still down considerably compared to 2014 levels, but where it's really down is on the long life cycle projects. So, the projects of type where you invest today and you start seeing oil 3 or 4 years from now, and then you see oil for 30 years, like a big offshore project or what have you, or a Canadian oil sands project. Those are the ones that have really dropped off because you see, we talk about energy transition and action on climate change and alternative fuels and peak demand and all that. That's not happening tomorrow. Yeah. But an oil sands project also, if you had one, so the Mark Carney, Danielle Smith magic wand, we build a pipeline, and then we start getting new oil sands projects. None of those projects are going to see first oil for at least 3 years.
Right.
And they're probably not going to reach peak production for 5 years from now. And then they're going to be designed to produce. So now you're at 2030. So now your bet is not on the global oil market today or 3 or 4 years from now. It's the global market from 2030 to 2060 or 2065. And so that's in some ways a much harder question than if you were saying the global oil market, you go back to 2010 or a little bit before, we were more convinced that we were short oil, that we didn't have easy opportunities for oil. That people
peak oil was kind of just hanging there.
Yeah, I mean, peak oil as a term has been around forever, right? I've been re-listening to Daniel Yergin's History of World Oil, the prize. They just released the full unabridged audiobook. So it used to be, I don't know, it's still an absurd time, but I think it was like a 9-hour audiobook before, and now it's like a 27-day long audiobook thing. Anyway, but I think it's 27 hours. But but they're talking about, the early discoveries in the US and how long people were predicting that before that resource would peak. So you've always had this world. But what's changed is that sort of perception of the flatness of the supply curve, to use my econ language, that we used to think, well, hey, we've done all the easy stuff, and the next stuff is oil sands, and the next stuff beyond that is coal to liquids or gas to liquids, like something that's really emissions intensive and expensive, and long cycle and big capital and all that. Yeah. Whereas now I think the expectation is that we have sort of an absurd amount of oil available to us at or about current prices. And you see evidence of that, like, Israel's bombed Iran and the oil price went up for like 24 hours. Right? In oil market kind of historic context, the type of uncertainty and unrest we've had in the Middle East in the last 5 years, and to say nothing of Russia, Ukraine, would have been massively unsettling for the market. But the market sort of taken a lot of it in stride just because there's so much oil available.
Yeah. All right. Well, this was all very fascinating, and that's a lot to digest, but I think it gives us a good grounding about how the conversation is going to shape itself. So thanks for doing this.
Oh, thanks for having me again.
All right. Thanks. And that's everything for this week. Join us again next week for some more Canadian politics. I'm Dale Smith. It's at journo_Dale on Twitter and journodale_no_ on Bluesky. And don't forget to like the video, share, subscribe, and support us on Patreon. Thanks, everyone.